Hello everybody. At this time we are talking about the capital asset pricing model or CAPM. The capital asset pricing model or CAPM describes the relationships between systematic risk or the general perils of investing and expected return for assets, particularly stocks. It is a finance model that establishes a linear relationships between the required return on an investment and risk. CAPM is based on the relationships between an asset's beta, the risk-free rate, and the equity risk premium, or the expected return on the market minus the risk-free rate. CAPM evolved as a way to measure the systematic risk. It is widely used throughout finance for pricing risky securities and generating expected returns for assets, given the risk of those assets and cost of capital. And then we move to role of beta in CAPM. In the capital asset pricing model, beta is a key measure of systematic risk, which reflects how a securities returns more in relation to the overall stock market. It indicates a stock's volatility compared to market fluctuations. A beta value of 1 suggests that the security moves in line with the market, whereas a beta greater than 1 indicates higher volatility, meaning the stock is more responsive to market movements. Conversely, a beta below 1 signifies lower volatility, implying the stock is less affected by market changes. Investors use beta to assess risk levels and make informed portfolio decisions. And then how the CAPM works. CAPM focuses on systematic risk, that is, risks that impact the entire market and are unavoidable, such as changes in inflation, interest rates, or government monetary policies. On the flip side, unsystematic risk can be minimized through investment diversification. They relate to the unique characteristics of the investments, such as industry regulation, capital structure of the business, and competition. And then what are the CAPM theory assumptions? Under modern portfolio theory, there are two core assumptions that underpin the capital asset pricing model. The first, efficient markets. The financial markets are competitive and efficient in terms of information collection, which impacts the pricing of securities in the markets. Identifying mispricings in the market is becoming increasingly challenging. Second, rational investors. The participants in the financial markets are assumed to be rational, risk-averse investors for the most part. The cost of equity is most commonly estimated using the capital asset pricing model, which connects the expected return and security for portfolio of securities to its sensitivity to the broader market. And then, who uses the capital asset pricing model? Many areas of the finance industries use CAPM. For example, investment bankers and investors may use this model to determine if an investment is worth the risk or to analyze how well an investment portfolio will perform. The capital asset pricing model is sometimes used to help calculate other important metrics in finance too. For example, CAPM ultimately can calculate the cost of equity, which is essential for figuring out a company's WACC, or weighted average cost of capital, how much the company pays to finance its assets. And then we move to advantages of the CAPM. The first advantage, it considers only systematic risk, reflecting a reality in which most investors have diversified portfolios from which unsystematic risk has been essentially eliminated. And then second, it is generally seen as a much better method of calculating the cost of equity than the dividend growth model, in that it explicitly considers a company's level of systematic risk relative to the stock market as a whole. And then third, it is theoretically the third and derived relationships between required return and systematic risk, which has been subject to frequent empirical research and testing. Fourth, it is clearly superior to the WACC in providing discount rates for use in investments appraisal. And then how to calculate CAPM. To calculate the expected return using CAPM, or the first, identify the risk-free rate, which is usually the yield on government bonds. Second, determine the investment's beta by comparing its historical returns to the market. Third, estimate the expected market return. And fourth, plug these values into the CAPM formula to find the expected return. And then we move to limitations of CAPM. The first, unrealistic assumptions. CAPM relies on several unrealistic assumptions. It assumes that all investors have the same expectations about risk and return, which is rarely true in practice. It also assumes markets are perfectly efficient, meaning that all information is instantly reflected in stock prices, which does not always happen. And then second, instability of beta over time. CAPM uses beta to measure a stock's sensitivity to market movements, but beta can be unstable. It is based on historical data, and a stock's beta might change over time due to shifts in the company's business model, industry conditions, or broader economic changes. And then third, challenges in estimating the risk premium. Estimating the market risk premium in CAPM can be difficult. The risk premium represents the additional return expected from investing in the stock market versus a risk-free asset. There is no consensus on what the correct risk premium should be, and it can vary significantly depending on the time period or data used. I think it is enough. Thanks for watching.